Good evening, everyone. Uh, we'll go for Unit 3 of Strategic Corporate Finance. This is the last unit of our fourth semester finance specialization, Strategic Corporate Finance. Unit 3 is Corporate Tax Structure. There are three things mentioned in the syllabus, that is corporate tax planning, concept and types of corporate tax, only basics, indirect tax structure, concept, and GST, meaning and concept. So it is a basic tax module which has been given. Let us go for this. Now, corporate tax planning. Corporate tax are annual taxes payable on income of a body corporate operating in India. A company is a legal entity formed by a group of individuals to engage in and operate a business, commercial or industrial enterprise. A company may be organized in various ways for tax and financial liability purpose depending on the corporate law of its jurisdiction. According to Section 217 of Income Tax Act 1961, company means an Indian company, corporation incorporated outside India, entities assessed or accessible as company, any association, institution or body declared to be a company by CBDT. Types of corporate tax. So there are mainly four of these corporate taxes. Minimum alternate tax, MAT. This is a minimum tax which a company has to pay if in case it wants to defer its tax liability. Fringe benefit tax. This is a tax which is to be paid on fringe benefits offered by the company to its employees. Dividend distribution tax. This is a tax which is to be paid on the dividend. Banking dividend to be distributed by the company. Banking cash transaction tax. This is the tax which is to be paid by the company on the cash transactions done at banking level. Now, corporate tax planning. What are the deductions? There are cash allowances, depreciation, stock and inventory, interest, and any losses, if any. Now, what are just a bit of revision? What are the classification? What are the types of companies? So, according to incorporation, there are three types: chartered companies, the statutory companies, and registered companies. According to liability of the company, company with liabilities limited by shares, companies with limited liabilities limited by guarantee, and companies with unlimited liability. And number of members: public companies and private companies. Chartered companies are the companies made by law. Statutory companies, chartered companies are companies which are made by the charter of the sovereign. For example, East India Company was a chartered company. The statutory company is the company which is made by the law. For example, LIC. Registered companies are the companies which are registered with registrar of the companies. For example, Tata Steel. Liability of according to liability of members, companies with liabilities limited by shares, the where the liability of the members of the company are limited by the shares by they hold, and the companies with liability limited by guarantee, so they here limited by guarantee. And with unlimited liability, it means unlimited liability, even their personal assets can be taken if the company is not able to pay off its debt. Now, according to number of members, public companies and private companies, there's restriction on the membership of the private companies. The shares of the private limited company cannot be given to the public, and public companies, the shares are with the public, so that is not an the number of the shareholders can be infinite. Now, indirect tax structure concept. The tax structure in India is a three-tier federal structure. The central government, the state government, and the local municipal bodies make up this structure. Article 256 of the Constitution states that no tax shall be levied or collected except by the authority of law. Hence, each and every tax that is collected need to be backed by an accompanying law. Without law, no tax can be collected. The tax system in India allows for two types of taxes: direct taxes and direct tax and indirect tax. Direct tax is where incidence and impact is on the same person. It means incidence means the application of the tax, and impact means the person who pays the tax. So if the application of the tax and the person who pays the tax is same, then that is direct tax. And if incidence and impact of the tax are on different persons or on separate persons, then that is indirect tax. Now, in India, three government bodies collected direct and indirect taxes until 1st of July 2017 when the GST, Goods and Service Tax, was implemented. GST incorporates many of the indirect taxes levied by the states and the central government. So, it includes now we have got integrated one tax structure, indirect tax structure, in the full name of Goods and Service Tax. Indirect tax structure concept, government bodies. For a smooth implementation of Indian tax system, there are bodies dedicated to it, popularly known as revenue authorities. First one is a CBDT, Central Board of Direct Taxes, a part of Revenue Department under Ministry of Finance. It has twofold role. One, it provides important ideas and input for planning and policy with regard to direct tax in India. Second, it assists the income tax department in the administration of direct taxes. CBEC, Central Board of Excise and Customs, deal with the policy formulation with regard to levy and collection of customs and central excise duties and service tax. CBIC is a post GST implementation. The CBEC has been renamed as Central Board of Indirect Taxes and Customs. The main role of CBIC is assisting the government in policy making matters related to GST. Now, what are the taxes subsumed in GST? So, central taxes which are subsumed in GST are central excise duty, service tax, duties of excise, medicinal and toilet preparations, additional duties of excise on goods of special importance, additional duties of excise on textile and textile products, additional duty of customs, commonly known as CVD, special additional duty on customs, central surcharges and cesses so far as they relate to supply of goods and services. Then state taxes which are subsumed in GST are state VAT, central sales tax, luxury tax, entry tax, entertainment and amusement tax, taxes on advertisement, purchase, entry tax, taxes on lotteries, betting and gambling, state surcharges and cesses so far as they relate to supply of goods and services. So these are the things which have been these are the taxes which have been subsumed in GST. Let us talk about GST. GST is an indirect tax or consumption tax used in India on supply of goods and services. It is a comprehensive multi-stage destination based tax. Comprehensive because it has subsumed almost all the indirect taxes except a few state taxes. Multi-staged as it is, the GST is imposed at every state in the production process but is meant to be refunded to all the parties in various stages of production other than the final consumer, and as a destination based tax it is collected from the point of consumption and not of origin like the previous taxes. Goods and services are divided into 5 different tax slabs for collection of tax: 0%, 5%, 12%, 18%. These are the tax slabs. Now, if you look into GST, there are central GST and state GST. Central GST, it will subsume the following taxes: central excise duty, additional excise duty, service tax, countervailing duty, additional duty of customs, surcharges, education, secondary higher education cess. State GST, it will subsume the following taxes: VAT, sales tax, purchase tax, entertainment tax, luxury tax, lottery tax, state surcharges, cesses leviable on the above as of now. Now, goods supplied or services provided, their interstate, when there is within the state, intrastate movement of goods and services, then central GST and state GST apply. When interstate, outside the state or between two states transaction takes place, an integrated GST, planned additional tax is applied. So now when it is within the state, then central GST and state GST apply, and when it is between states, then integrated GST and additional taxes apply. Now, feature of GST, it is applicable on supply of goods and services based on the principle of destination. It means it is taxed at destination. 3 models of GST are there, that is central GST, state GST and integrated GST. Integrated GST for interstate transfer, integration of various taxes, and GST Council has been made after coming of GST, which decides on the slabs and various policies and principles related to goods and service tax. Now, objectives: eliminate cascading effect. Previously, what used to happen is cascading effect is when same thing as tax twice, and this tax eliminates cascading effect. improves competitiveness in GDP, ensures availability of input credit. So input credit is available because of a tax deducted at source and at value added. Reduction complications. There are complications have been reduced. There is one unified law. The next one is unified law, decreasing unhealthy competition and reducing tax slab rates. So tax slab rates have been reduced because when there was no GST, effectively a big percentage was paid as indirect tax. Merits an end to cascading effect, growth of revenue in state and union, reduce transaction cost and unnecessary wastage, eliminate multiplicity of taxation, one point single tax, reduces average tax burdens and reduce the corruption. Demerits, high tax burden for manufacturing SMEs. So manufacturing SMEs are facing high tax burden now, increase in operating cost because of increase in tax compliance, change in business software, increase in taxes will increase price, registration in multiple states. This is the biggest problem because now they have to register from in various states where any firm want to move its goods and services. Problem in e-commerce, composition scheme is not available for many business, and no anti-inflationary measures. There's no anti-inflationary. If in case the prices go on inflation, then what will be there? There's no measure related to that. Now, export and import under GST. If you look at export of goods has been covered under Section 25 of IGST, Integrated GST Act 2017, Indian GST Act 2017, taking out of India to a place outside India. Now, zero rated, there's no GST charged and refund is allowed. And in case of services, Section 26 of IGST applies, and it means supplier located in India, recipient located outside India, the place of supply of services outside India, payment received is convertible foreign exchange, and supplier and recipient of service are not merely establishment of a distinct person. So, and again it is zero rated. So in goods and services, there's if in case of export there is no rate of GST. Then in case of export, in case of import is treated as interstate supply. So in case of goods, it is treated in section 210 of IGST, bringing goods into India from a place outside India, and there is levy of tax, which is custom duty, basic custom duty, then integrated GST, and some cess is there. Then under the Customs Act 1962, read with the Customs Tariff Act 1975. So basic custom duty is charged and integrated GST is charged, and plus some cess is also charged. In case of services, it is covered under Section 211 of IGST. Supplier located outside India, recipient located in India, and the place of supply of service is in India. Then levy of tax is a registered recipient on reverse charge, and levy of tax either by OIDAR by unregistered person, payable by supplier appointed person. So if you look into this in export, there is zero rated supply, no tax shall be charged. In case of a tax structure, and input tax credit is allowed, refund shall also be allowed. And in case of import, IGST and basic custom duties charged shall be levied, and in ITC of IGST allowed, ITC of basic custom duties are not allowed. So this is end of the third unit. I hope you enjoyed the session. It was a small one, and with this we come to end of strategic corporate finance. Thank you. Have a nice day.